All right, let's talk about Singapore REITs. A new report from DBS has just dropped, and it's making some pretty big waves. They're basically calling for a major comeback in 2026, which is huge news, especially after the rough patch investors have been through. So, is a turning point really just around the corner? Let's dive into the numbers and find out.
And boom, right out of the gate, the report hits us with this: a 2-year sustained earnings upgrade cycle. Now, let's be clear, they're not just talking about a simple bounce back. This is a much bigger deal. We're talking about a fundamental shift, a real change in direction for the market, lasting from 2026 all the way through 2027. So you have to ask, right, what's behind all this optimism?
Okay, take a look at this. This chart really tells the whole story, doesn't it? You can see just how tough the last few years have been for investors. I mean, those payouts, or DPUs, were in the red. It was a rough ride for sure. But then, look at 2026. That's a massive swing into the green. We're talking a projected 4.1% jump. That's not just a little bit of good news. It's a serious rebound. It kind of feels like the sector can finally breathe again.
So, this is the big question, right? Why the sudden good news? Well, it really boils down to one huge thing: the cost of money. Let's talk about interest rates.
And this chart really paints the picture. You can see rates have been dropping across the whole region. But check out Singapore. That's SG on the far left. That's a pretty steep drop since the peak back in 2022. And for businesses like REITs, which, rely heavily on borrowing, this is fantastic news. It's a much friendlier environment for them.
And it looks like this good news isn't a one-time thing. The forecast shows the cost of debt for these REITs should keep on falling through 2026 and even into 2027. Think about it. Every time a REIT has to renew an old loan, they can now do it at a much cheaper rate. And those savings, they go straight to the bottom line, which means better performance and, you guessed it, bigger payouts for investors.
Okay, quick pause. You're going to hear me say DPU a lot. It just stands for distribution per unit. All it means is the cash that you, the investor, get paid for each unit you own. So if you're familiar with stocks, just think of it as the dividend. Simple as that. When DPU goes up, you get more cash.
And here's the kicker. The number crunchers over at DBS figure that just from these interest savings alone, we're looking at an average DPU boost of about 2.5%. Now that might not sound like a huge number, but remember, this is before you even factor in things like rising rents or new buildings. It's like a free push forward for the whole sector, a really powerful tailwind.
All right, so we get the why. It's all about cheaper money, but not all property is the same, right? So the next big question is where? Which specific areas are poised to do the best?
And to figure that out, the report uses this really cool visual. They call it the Singapore property clock. It's a clever way of showing that different types of property, offices, shops, warehouses, are all on their own timeline. Some might be at their peak, others might be hitting rock bottom and getting ready to climb back up. It just gives you a great snapshot of where everything stands.
And if you look at their clock, the message is pretty clear. Both office and industrial properties are sitting right in that rising market phase. What that tells us is that the analysts think these two sectors have already hit their low point and are now starting to climb, with some serious momentum carrying them into 2026.
So here's how they break it down. They're most bullish on office space. Why? Well, basically, not a lot of new office buildings have gone up, so supply is tight, which could push up rents. They also really like industrial properties, thanks to all the demand from tech and logistics. But they're a bit more cautious on retail, with people maybe not spending as much. And for hospitality, they seem to prefer the more diversified lodging options over just straightforward hotels.
Okay, so this all leads to the million-dollar question for any investor watching, right? With such a positive outlook, is now the time to jump in? Let's look at what the report says about timing.
So let's put it all together. What does all this mean for you if you're thinking about putting your money into S-REITs right now?
Well, this chart gives us a clue based on history. Right now, S-REITs are trading at about 0.9 times their price to book value. Now, what on earth is that? Basically, book value is what a company is worth on paper if it sold everything and paid off all its debts. So at 0.9, the market is actually valuing these REITs for less than their assets are worth. And here's the interesting part. Every time valuations have dipped this low in the past, the returns over the next year have been positive. That's why you're hearing analysts call this an attractive entry point.
And they don't just stop at the big picture. The report actually names names. Here are a few of their top picks. You've got Capital Land Integrated Commercial Trust, CICT, which they like for its steady growth, and Mapletree Logistics Trust, which they point out is trading at a good price. So these are the specific ideas they're putting on the table.
Okay, but it can't all be good news, can it? A good report always looks at both sides. So while things look promising, we absolutely have to talk about the risks. What could possibly go wrong?
So here are the main things to keep an eye on. First and foremost, this whole forecast is built on the idea that interest rates will keep falling. If the US Fed decides to get hawkish, which is just a fancy way of saying they might raise rates again, then this whole picture could flip. Second, a big global recession would obviously be bad news for property demand. And finally, if people in Singapore stop spending as much, that's going to hit the retail REITs pretty hard. These are the big what-ifs you have to weigh.
So that's where we land. On one hand, you have a really compelling story for S-REITs. You've got this interest rate tailwind and valuations that look pretty attractive based on history. But on the other hand, you have some very real, very big risks tied to the global economy. And that's the classic investor's dilemma, isn't it? Is the potential reward here big enough to outweigh those risks? That's the question you have to ask yourself.